Hey everyone, today on the final bar, we're going to wrap up this week looking at a resilient Friday afternoon, just chipping away on the upside. S&P finishing near the highs of the day, or at the highs of the day, just under 3180. So what does this mean for the long-term trend? We're still in that range. We're getting back toward the upper end of it. So we'll talk about some of the movements in large caps versus small caps. Also, we answer some of your questions from the final bar mailbag. Some very thoughtful questions about China, trend lines, and elsewhere. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets together, to watch this resilient bull market phase continue to chip away. And every time I feel like you get a good handle seeing some distribution, a day like today comes along and it feels like everything is just long and strong up and to the right. So what we're going to try to do today is look at some of the longer term charts, see how they've evolved over the last 5 trading sessions, and see what sort of themes we can tease out using the Mindful Investor Live ChartList. And it's pretty impressive, actually. One of the things I would, be talking about is just the differentiation between the mega cap, large cap trade stocks like Tesla, Amazon, overbought, if not extremely overbought, versus small caps that are actually, still below their 200-day moving average. A lot of them struggling. The breadth is a lot weaker in that space. Then a day like today, small caps actually up 1.5%, doubling the returns, the upside return of the S&P. So let's look at the charts together. We'll see what we can see. Now today, Friday, we'll be wrapping up this week. And next week is a huge week on StockCharts TV. It's called Charting the Second Half, something we've been planning for a number of months now. And it's going to be fantastic. We're going to have special guests on the final bar, including people like Rick Benson here on Monday, Tony Dwyer from Canaccord Genuity joining us on Tuesday. I know Mariel McGonigal is going to come by one of the days as well. And all of them actually, their interview on my show is going to be a preview of their own special event that they're going to be giving the next day. So you're going to have a lot of the regular StockCharts TV hosts providing some good ideas. You're going to have some special guests. We sat down with Ralph Atkinpour not too long ago and recorded a really cool interview that we'll be sharing with you next week. I'm going to be doing a show with Carl Swinland to get his take on the second half of the year. And then the big finale of the week is on Friday the 18th at noon Eastern or 9 a.m. Pacific. I'll be moderating a panel featuring some of our StockCharts contributors, guys like Greg Schnell, Julius DeKempener, Grayson Rose, also John Kosar from Asbury Research, all on a panel together. It'll be a live interactive discussion, so we'll be able to ask questions right of the panelists as we understand their take on the second half of the year. So a lot of really good content next week. Hopefully we'll equip you as much as we can to approach these markets for the next 6 months. Let's get to our wrap the week session, trying to make sense of this market today. And just to really quickly summarize what we saw, and then we'll get to the Mindful Investor Live chart list. Just a couple quick observations from looking at the markets here this afternoon. The S&P finishing up 0.7%. It's around 3175. The NASDAQ was up a little less than that. So this is one of those weird days, which I'm told happens sometimes, but I sure haven't seen it in a while, which is the market up, but technology down. Which is kind of an interesting development for sure. Tech has been, one of the top sectors. So the market went higher today. Small caps actually led the way, up 1.6%. Mid caps up 0.9%. The VIX is a little lower, back below 28. So the S&P up. But look at what led the way higher. Financials up 3%, utilities up 1.9%, energy up 1.8%, consumer staples up 1.5%. The stuff that has been leadership, things like tech, biotech, healthcare, actually down today. So this was, to be honest with you, a weird day. It is not sort of a business as usual, things just kind of going higher. This is a bit of a rotation of sorts. People going into some of these beaten down groups that have been lagging. All three of these were, I feel like, have been at the bottom of the list most of this week. So sort of an interesting mix. And one of the other ways I just want to show you how today was kind of weird This is the industry summary page. So the way you get to this is click on Charts and Tools, and then you'll see an option for industry summary. You can also get to it from your dashboard. What I do is I go on table view, and then I sort it by scooter rankings, which means you're looking at each industry group in order from strongest to weakness over the, essentially over the longer term trend. If you look at most sectors, you'll see the stuff that was down is at the top of the list, and the stuff that's up today, and that's the bars over here, are at the bottom of the list. So it's sorted by the long-term trend, and I'm showing over here the percent change today. So you can see within communication services, the biggest groups were broadcasting and entertainment, media agencies, which are some of the weaker groups within communication services. Consumer discretionary, a little weird because you have Tesla and automobiles group going vertical essentially. So this one was sort of a mixed bag. But as we go on, you can see within consumer staples, biggest groups, tobacco, tires, which are at the bottom of the list. Within energy, the leading groups are coal, oil equipment and services, E&P stocks, which are at the bottom of the list, single digits, according to their scooter rankings. Within financials, the strongest ranked trends, which are specialty finance, financial administration, these are things like, boy, I shouldn't try to come up with names. I want to say this is like MSCI, S&P Global. I want to say those are those groups down, and the ones that are leading are these insurance and bank groups, which are at the lower end of the list. So I can keep going, which you can see with most sectors, the strongest moves today were the most beaten down groups. So this was certainly, in materials especially, look at this, gold stocks down at the top of the rankings. The things at the bottom, steel, aluminum stocks, were actually up pretty meaningfully. So this sort of happened in most sectors outside of consumer discretionary, showing you sort of a right sizing. This is a bit of a rotation away from tech and some of the biggest leadership names into some of the other names. It actually led the market to go higher. So we'll look at those charts here in a moment. I thought it was an interesting sort of rotation of sorts just today, actually. Let's get to the Mindful Investor Live chart list. This is how we usually look at the markets together on a Friday afternoon. If you've not seen this before, if you've not looked at this chart list before, click on articles, go to my blog, which is called the Mindful Investor, and you'll see at the link at the very top to go to this live chart list. You can save it to your own login and use it however you want. We'll start with the long-term trend in the market. This is the S&P market trend that I followed for a number of years, and essentially gives a long-term, medium-term, and short-term, very systematic bull or bear call based on long-term moving averages. So the longest signal is based on the 21 and 34 week exponential moving averages, and the way you can look at that is the PPO here at the bottom. So if it's above zero, that means the trend is positive. If it's below zero, the trend is negative. This turned positive in early June and has remained positive up through today. So overall, just saying that longer term, sort of that secular trend, the long-term cyclical trend is positive. What I call the medium trend is using the regular weekly MACD or the weekly PPO and just using them how they, the traditional signals when they cross up and down through each other. This turned positive in early May and has remained positive through today as well, just suggesting that medium term trend is positive. The short-term trend, I just use the difference between these two. And again, it's not a perfect read. I usually look at the daily chart more for it, but I find having them all in one chart can be kind of helpful. So I'm just looking at the difference, the histogram here, which shows you the width of these two moving averages, and the wider they are on the positive side, the bullish, it's in a bullish read. If it's narrowing or going negative, then it turns negative. And so for the last couple of weeks, tactical short-term trend has been positive. So pretty much across the board, the trends are positive, and that's about what it feels like when you look at charts like Amazon and Tesla and Activision Blizzard and all these stocks that are overbought to extremely overbought. So the question obviously is, at what point do you see some kinks in the armor? I haven't seen them today for sure. Chart number 2 is looking at a daily chart of the S&P. There are a couple different things that we've noted here in recent weeks, if not months. You know, the first was this bull flag, which was the big run out of the March lows, the parallel pullback, this corrective pattern of lower highs and lower lows, that resolved to the upside here in mid-May. This is when the S&P broke above that last Fibonacci resistance level, which suggests, actually measures, if you use the traditional measurement, it gives a target of S&P 3600. Which again, it's sort of suggesting if that's a midpoint in the trend, we've got a lot more upside. Now, more recently, we faced what I'd call a bullish pennant pattern, which is lower highs, higher lows, which has resolved to the upside. So it's broken above the trend line using these swing highs. We've now broken above this resistance of 3150. The challenge we've had on a day like today, great, we've broken above resistance. Yes, that should clear the way to continue on, arguably to 3,400 and retest the previous highs. This has happened, though, a number of times in the last week and a half, and every time we've done what we did today, the next day we end up going right back below 3,150, and it just further establishes that as a resistance level. So today, nice breakout. I'd want to see a follow through into next week, and that's what I'd be waiting for there. You know, breadth by cap tiers is actually a really interesting chart right now. One of the questions in our mailbag is about advancers decliners, a really thoughtful question that I'll share with you and give you my take on it. But, you know, one of the things I've noticing is this dispersion, this differentiation between breadth on the large cap stocks versus breadth on the small cap stocks. If you look at the cumulative advanced decline lines, this is taking the daily advancers decliners, just keeping a running total and looking at how they evolve over time. In general, when the market's going up, the advanced decline line is going to go higher. When the market goes down, the advanced decline line is going to go down, mainly because there are more down days in a downtrend and more up days in an uptrend. That makes sense. What you look for is when there are some divergences, right? Higher highs in the price, lower highs in the advanced decline line, or also when they differentiate on cap tiers. And I can't help but notice that the cumulative advanced decline line on the S&P has broken above its June high that happened earlier this week. If you look here at small caps, not only is it nowhere near its high from that same day, it's actually broken. This is as of yesterday's close, threatening to break down below the low from about a week and a half ago. So you have this situation where a large cap breadth positive, everything else neutral, except for small cap, which is arguably a little bit negative. And what concerns me is if you look back at topping patterns, a lot of times that's what will happen. You can see that here in January to February, and this is, you know, much more of a clear read here over a month or so. Higher highs in the cumulative advanced decline for large caps, but then everything else kind of flat to down, and small caps especially sloping downward. So will be interesting to see if that's the same pattern that we're seeing here, but I can't help but notice it looks eerily similar to that pattern. Higher trend in the large cap breadth, lower trend in small cap breadth, and that tends to mean people are kind of going risk off and taking really speculative bets in small caps off the table. Looking at new highs, new lows, it's been relatively limited because, again, most stocks are sort of range bound, but you do have a handful of names like Amazon and others that are at or near new highs. That's pushing this to a consistent positive number. So over the last week, it's been about 30 to 40 plus stocks on the S&P, which, again, you think about that, it's about 6 to 8, 9% or so of the S&P making new highs on a given day. That's not outrageous. And in normal bull market phases, you'll see a much higher number. You can see back here in January, as we were getting to the end of this bull market phase before the February peak, you know, you had over 20, 25% of the S&P making a new high on a given day. We're nowhere near that. So it's not extended by that read, but again, it's a little different because we're sort of in, you know, within this broad range for the overall market. You know, worth noting as we continue this discussion of long-term charts, you know, less than 50% of the S&P above their 200-day moving averages. As I've mentioned, I would feel much better about long-term positive returns, expecting the S&P to get to 3,400 plus. If this would get back above 50%, which tells me over half of the S&P is back above their 200-day moving average, so many stocks still not able to do that. It's about 40% of names that are currently above their 200-day. So until that improves, I'm a little skeptical about long-term upside from here. It doesn't tell you there's long-term downside necessarily. It just tells you a lack of potential for a lot of upside from here. Also worth noting that we're back down to around 50% of the S&P above their 50-day. That's down from almost 100% just a couple of weeks ago, maybe a month or two ago. Looking at a little bit of sentiment, the AAII rankings pivoted a little more to the bullish side. So bulls increased up to 27%, bears decreased down to 43%. So still, more bears than bulls, about to the tune of about 15, 16%. But overall, that has narrowed. So over the last 3 weeks, you had a almost 2-to-1 ratio of bears to bulls. That's actually come in a little bit, which tells you individuals getting a little more optimistic, especially given this week with some further upside. You know, this is a chart looking at strength within consumer. It really tells the story of Amazon. When Amazon does well, when a big mega cap stock like Amazon does very, very well, it's going to skew how a sector feels. So consumer discretionary as a cap-weighted sector doing very, very well, making new highs over the last couple of weeks. On an equal weighted basis, and this is versus consumer staples, on an equal weighted basis, it's actually making new swing lows this week. And that can happen because Amazon is such a big weight. When you take that overweight out and you equal weight all the consumer discretionary stocks, you can see that it's less attractive just being in consumer discretionary. There are opportunities within staples, but the relative strength of consumer discretionary versus technology remains fairly negative. Semiconductors have been strong and remain so. A bit of a pullback today as tech has sold off, but overall it's been interesting. This is a key chart to pay attention to, and I think there's a sort of an inflection point alert here. Small caps have been outperforming since just before the March low. That potentially has certainly changed here with breaking down through this uptrend channel from the lows. This is the IWM, the Russell 2000 versus the S&P, sort of rotated lower below the lower item here. Growth continues to outpace value. I don't see that changing today, and certainly don't see that changing based on the chart. It still favors growth over value. High beta has come in a big way versus a low vol. That's not a new thing this week. That's actually been evolving for quite a while. And then very finally, I just want to point out the fact that emerging markets have certainly emerged very strong. We're going to look at a chart of China here in a minute, but it's worth noting U.S. has been underperforming global stocks for the last 2 months, and that's based on weaker dollar and a number of other things as well. I'd encourage you, again, if you, as with many investors, I think very rightfully so, have ignored looking at international markets because U.S. markets have been so much better suited. The relative performance has been here, and I get it. That's changed though, and because of the weaker dollar, you're seeing trends emerge outside the U.S. that are worth paying attention to. Finally, I haven't updated the arrow here, but I think you'd put maybe an amber arrow right now, sort of showing that stocks and bonds are sort of in lockstep. Stocks sort of drifting higher this week, bonds breaking out of a congestion range as well. So overall, it's sort of been either or. They're both appreciating in a pretty decent clip this week. That is our Wrap the Week segment for today. And again, a lot of just sort of big picture charts to review. Again, overall, this has been a week of consolidation, but certainly finishing stronger relative to some of the other days this week. For me, as we close higher on a Friday, I want to see follow through on Monday. You know, some good news, I think, in terms of coronavirus and news from Gilead on drug treatments, but you know, the weekend can bring a lot of news as well. So let's see what Monday brings to us. If we do get a follow-through day to the upside, I think that certainly clears the way for being more optimistic about further upside in stocks overall. We need to take a quick commercial break. We'll be back answering questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. Thank you so much for sending so many great questions. We received a number of fantastic questions from you this week. And as a reminder, the Final Bar at StockCharts.com, that's the best way to get a hold of us, or on Twitter at FinalBarSCTV. All the questions I'm going to share with you now we've received in the last day or two from one of those avenues, and let's get right to it. So question number one is on the FXI. Yesterday, I want to say, or the day before, I showed the FXI, the China large cap ETF. And the question is, you know, my chart is showing that we're just testing resistance. Your chart is showing that we've broken above resistance already. I know where this is going. So this was the chart that I showed yesterday. I think this was in the 3 and 3 yesterday or the day before. And my comment was, we've tested resistance here from 2019. We tested it again, January, broke above it. Now we've broken above it and we're retesting it from below. And I noted the fact that it's overbought, and that lines up with some of the patterns we saw previously. Overbought, testing that level, it suggests a bit of a short-term weakness. I bet your chart looks more like this, which is how this looks if you take the adjustments out. So this is one of the things about price data. You have a couple choices you can do. Number one, you can adjust the price data, which means when a company reports dividend, you basically adjust all the historical prices for the dividend payment, because otherwise you have these gaps on the chart every quarter, every month, whatever it is, that are adjusting for the fact that there's a dividend payment, right? The payment goes out as a dividend. You adjust the price of the stock because that's what's paid out. And so you know, there are arguments on both sides. You know, talking with Chip Anderson, our founder, talking with John Murphy about this. You know, the benefit of using adjusted data is your indicators are all going to be based purely on price and not based on artificial gaps because of dividend payments. However, though, it's going to skew, you're looking at historical prices. So if you don't adjust the data, if you look at unadjusted data, then you're looking at where the FXI actually traded in April of 2019. It was here around $46. If I adjust the data, it's going to change that value. So here's the thing. If you're looking at long-term support and resistance, you should unadjust the data, which means you put the underscore in front of the ticker. So underscore FXI, and this is probably what your chart looks more like, which is a much better way of looking at resistance. You are correct. And so in this case, you can see we actually are right at the April 2019 peak. This is where the FXI peaked out around $46. We hit that almost to the penny, which makes a ton of sense to me. And now we've pulled back a little bit. If you don't adjust the data, which is this chart, you can see that it basically inflates this a little bit because we haven't taken the dividend adjustment on there. So again, for indicators, this is actually a better way to use it. But if you're looking at support and resistance, put the little underscore along there, and you'll see what I saw, which is price hitting resistance. Either way, I think it makes sense that the FXI is right at resistance, and I'd expect a bit of a pullback. Thanks for that question. Question number 2, I'm doing some reading about trend lines, came across some articles that a famous trader, Trader Vic, wrote on the topic of drawing them. I've observed that some charter technicians will use the intraday high and low as the points. Others will use open and closing prices like the candlestick bodies or the closing prices. Are we taught that one way or the other is acceptable? That's a really, really good question. And so the short answer is I've seen people argue for both. I tend to use the open, high, low, close. And when you see me draw trend lines, I tend to use the high and the low prices. And I'll show you when I'm drawing a trend line, I would sort of use the low here, and I would use the low here. You know, times when I have strayed from that in any way would be times when there's a big weird gap, some weird thing that happened, like a flash crash or something, where taking that low doesn't make a ton of sense just based on how the markets actually operate. But for the most part, I would use the extremes in price, because you can't deny that prices, you know, the shares changed hands at that price level. So I think it's worth doing. I've also seen people, and I love the simplicity, someone like Jeff Weiss comes to mind, who I followed his work for years as a mentor of mine. He was at Jessup and Lamont, one of the oldest U.S. brokerages. He was there for a number of years, and now it's been a number of different places. He always uses just closing prices, weekly closes, monthly closes, and draws trend lines based on that. Later in your question, you got to, would you ever do, would you ever draw through the price something like this, which is called an internal trend line? And the short answer is no. I would strongly advise against doing something like that, because what you are opening yourself to is a lot of confirmation bias. When you can violate prices and start drawing trend lines anywhere you think there might be a trend, you are doing wishful thinking trend lines and not trend lines based on absolute price. So my recommendation to you, and what we are all taught, is use the highs and the lows, or another argument can be made of using the closing prices. And I think, to be honest with you, I don't know if there's a right or a wrong answer. I've seen people argue both of those. I'm not too married to one or the other. I've tended to use highs and lows just because that's how I learned it. Great question. Question number 3, the cumulative advanced decline lines. There's a really long question, so let me summarize here very, very quickly. Yeah, what's up with the fact that there is a consistent upward bias in the advanced decline lines? You shared this chart, so I'll show it to you. Here's the S&P 500 on a closing basis. This is going back just over 2 years, it looks like. This is the cumulative advanced decline line, which you can see is just as an uptrend over this period. Here's the equal-weighted S&P, and your question is essentially saying, number 1, what's with the upward bias in advanced or decliners? Number 2, equal weighting, is that a better way of looking at divergences because it's not upwardly biased? This could be a subject of an entire hour-long presentation, but I'll try to summarize it. Yes, I would say, especially in an extended bull market, which you could argue we've been in, there's going to be an upward bias. There are periods, like if you look at the NASDAQ, there are periods where the advanced decline line is just in a persistent downtrend. If you look at Japan during the lost decade, you'll just see this advanced decline line does not look super helpful. So over long periods of time like this, I don't use the advanced decline line for this sort of directional thing, because I don't think it's going to be as relevant. What I am looking at is this in this shorter term time frame. I think it is very valid when you see price do one thing and when you see advanced or decliners not confirming it. because in an extended bull trend, there's going to be this bias because on average, there are just a lot of up days, right? There's more up stocks than down stocks when the market's in an extended uptrend. When that changes, when the price keeps going higher, but the advanced decline line starts to not confirm that, I think that's where there could be a bit of an issue. When you're looking at equal weighted S&P, I think you're trying to tease out a similar thing, which is the uptrend in price because of a smaller number of names, maybe more defensive names that are continuing to go higher, while the average stock is starting to rotate lower. And I would say that in different times, both of those is going to illustrate that point. So I think you're right. Over the long term, I don't use advanced decliners for this sort of directional thing over this time frame because of the biases that you just mentioned. I do think in the shorter time frame, I look at both of these things: the cumulative advanced decliners, also equal weighted S&P relative to the S&P, which coincidentally is rotating lower as you're pointing out here. And if you look at it on a relative basis, it continues to go down because, again, it's sort of narrowing leadership, the big mega cap tech and Tesla and Amazon and those kind of stocks that are doing well. The average stock's kind of holding its ground at best. Really good question. Boy, that's all the time we have for questions. I wish we could get to some more of these. A really good question on the dollar that I'd love to save until Tuesday, and we have a little more time to go. I don't want to breeze through and not do that one justice. So let's move on to the final piece of the show, the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at small caps. This is the S&P 600 chart. And as I was going through preparing for the show, it just jumped off the page at me, the fact that the S&P is sort of above its 200-day, kind of up around here. The NASDAQ 100 breaking to new highs up around here, along with a lot of big tech names. And it's just the small cap index looks nothing like those. And the mid cap index is kind of similar. This is an index that failed at its 200-day, has pulled back, and now is just sort of stagnant. Not bad. It's not breaking to new swing lows, but it's certainly not validating any sort of uptrend. You can see it's underperforming. So again, while this chart is not bad, it's not telling me that the world is ending and it's getting really painful. It just tells me that the euphoria that you feel on a chart like Tesla or Amazon or Activision, this extreme up move, this overbought conditions, that's not a universal phenomenon. And if you look at the financial sector, it looks more like the small cap index. So until something like this starts to participate, you see the small cap index break above 840, you see rotation into those sorts of speculative names. I still have to just feel that even though the market can continue higher, and again, I still think being in tech and riding those trends positive certainly continues to be how I would think of it as a core position. The lack of participation with small caps certainly is an area of concern for me. Chart number 2 is the breadth by cap tiers. We talked about this a little earlier, and again, this tells a pretty interesting story of the large cap breadth remaining, constructive, the New York Stock Exchange and mid cap breadth sort of sideways, and then the small cap breadth more negative. We'll have to see how this week. I bet this will uptick based on the fact that small caps led the way higher today, but overall, this is as of yesterday's close. This is sort of the range that we're met with, from positive to medium to negative. And so that, differentiation with large caps working and small caps essentially not on an equal weighted basis is a bit of a concern as well. The final chart on my 3 and 3 is Amazon. I wrote an article that'll be out soon for our Chart Watchers newsletter, which comes out every Saturday morning, and talked about overbought conditions. We looked at 3 stocks: Amazon, Tesla, and Activision. Those are probably why I threw those names out a couple times. I was just writing the article before the show started here. But, with Amazon, you can see this situation when it has become overbought, and especially in February, extremely overbought. But each of these times you had higher highs in price, lower peaks in the RSI, this bearish divergence. That happened in February. It happened in April as well, which wasn't much of a pullback, but was a bit of a holding pattern before we resolved to the upside. And again, we have not seen that divergence yet. But when the RSI becomes extremely overbought, which is what you're seeing now on Amazon, you wait for that next push higher, which I think will come, and you look to see where that divergence might emerge. And a bearish divergence, higher highs in price, lower peaks in RSI, would certainly cause me a bit of a concern on a chart like Amazon. Folks, that's our show for this week. We'll wrap the week right about here. Thanks for joining us every weekday for The Final Bar. Please keep your questions coming. The Final Bar at StockCharts.com or on Twitter at FinalBarSCTV. We're going to be, I will be heading on the road with my family here momentarily, heading up to the San Juan Islands. So I'll be doing the show from there Monday and Tuesday, back here on Wednesday, but some fantastic guests all next week on StockCharts TV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.